It's Friday 10th of January, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and this is the first show of the year. There's already a long list of issues to get stuck into, so I'm happy to say that Neil Shearing, Group Chief Economist, is with me, and we have a special guest in the shape of Chief Markets Economist Jonas Goltermann. Hi Neil, hi Jonas.
Hi David. How are you doing?
Happy New Year. I was always under the impression that the new year takes a couple of weeks to get going, not 2025. I had been planning to say that it's been a lousy week for bonds. It's been a grim time for Chinese assets. Now we've got Donald Trump giving free rein to ideas about US territorial expansionism. But then we got that payrolls report, December non-farm payrolls. And wow, we're just a few minutes after the release. We're just ahead of the stock market open. Neil, what's your take on the report?
Pretty strong across the board. And if you look at not just the number of jobs added, but also unemployment rate ticked down. So number of jobs added, surprised to the upside. There was a pretty strong mix across different sectors of the job market too. Earnings, pretty solid, 0.3% month-on-month gain. And the unemployment rate, of course, ticked down. So strong across the board. However, you touched on the turbulence in markets since the start of this year earlier. I'm afraid as far as markets are concerned, this is a case of good news in the economy being bad news for markets. We've seen a leg down in S&P futures and, of course, a further leg down in the bond market, jump up in bond yields. So good macro news, pretty bad going down pretty badly in the markets, though.
Yeah, I was going to ask Jonas, going into this release, there'd been this sort of prevailing idea, hadn't there, that the market had gone too far late last year in the direction of Fed easing, and that what we'd been seeing in the previous few days / weeks had been a sort of repricing of those expectations of how much easing we'd actually get. Neil's just touched on it, but talk a bit about how these latest numbers are affecting sentiment.
Yeah, so it's a case of, as Neil says, good news is bad news to some extent certainly for the bond market and to some extent even for the equity market. And it continues the trend that we've seen at the start of this year, the trend that was already in place really for much of Q4 last year, which is the US economy is more resilient than anyone thought, more resilient than the Fed thought. And that is leading to fewer rate cuts being priced in for the Fed. We're now down to just barely more than one for this year. And therefore bond yields go up, the dollar goes up, and at least in the short term, that is putting downward pressure on the stock market as well, which is something we've seen several times over the past 2-3 years, where obviously the stock market has gone up enormously on net in that period. But when bond yields get towards this sort of get closer to 5% and 4%, essentially, the stock market starts to struggle a bit to make further headway, a bit like a climber going up the mountain and the air gets thinner and starts to falter. So I think if we do see bond yields keep going up like this or staying high, that is, at least in the short term, going to be a bit more of a headwind for equity markets.
Yeah, you've touched there on the Fed. We reduced our forecast for Fed easing after that December meeting, after they published the latest dot plot, the view of where board members think rates are going to be in the coming months. There's 2 rate cuts in our forecasts. Are they looking ambitious at this point, even those 2? I mean, how hot is this economy and how much of a threat is this idea of an inflationary resurgence?
I think it's still a reasonable base case to expect 2 cuts this year, although I'd have to acknowledge that a lot of this really does depend on the policy agenda pursued by the incoming Trump administration, of which there's an enormous amount of uncertainty around. So if we were to get large-scale discretionary tax cuts over and above the extension of the 2018 cuts, if we were to get even larger tariffs than we're factoring in, or even larger immigration reforms, migration caps and removals, then clearly the scope for further rate cuts diminishes substantially. So at the moment, based on the assumptions we're making about no significant additional fiscal expansion in particular, I think 2 cuts is just about defendable. However, if we were to get additional discretionary fiscal stimulus and support, and like I say, even bigger moves on tariffs and migration, then I think those 2 cuts do start to get called into question. And it wouldn't be a surprise if the Fed either cut once or didn't cut at all if you were to get really big fiscal expansion. So a lot depends on the policy agenda of the Trump administration. But at the moment, I think it's still reasonable to expect two cuts. Of course, the market is only pricing in 1 cut now. There's been quite a big turnaround in market pricing over the past few weeks.
We've spent a lot of this week talking about what's been happening in the gilt market with UK government bond yields and this idea that there's been a global bond sell-off, but there does seem to have been particular focus on the gilt market. And we did see a response, didn't we, Jonas, in the gilt market to this payrolls report. Why have gilts been in focus for so much of this week? But actually, first, why are they getting knocked about by this payrolls report?
I think when you see a sell-off in the treasury market, that tends to spill over to other bond markets. So they're all, in some sense, substitutes for each other, high-quality government bonds or the high-quality bit anymore. But so that's quite a natural reaction. And to some extent, it works the other way as well. The sell-off in gilts is bled into, to some extent, to other bond markets. But going back to why is the UK in focus, I think some perspective is in order. It's certainly true that gilts have sold off more sharply than other bond markets at the start of the year. But if you roll the clock back to, say, mid-December, or better yet, all the way back to September when bond yields trough in the US and globally, gilt yields aren't up more than US yields. They're up about the same amount. So it's not an outlier in that sense. Now, you could say that in the US, you've had a lot of good economic news in that period, payrolls today being the latest example of that. And that's why treasury yields should be going up, maybe not quite as much as they have. In the UK, the economic news has been more mixed. You might say that more of the gilt yield going higher is down to other factors, in particular fiscal. And that's a less constructive mix of factors, if you will. But I think why is the UK more vulnerable? There's a couple of reasons for that. One is down to, let's say, confidence in the UK public finances, which hasn't really recovered since the Trustonomics debacle back in 2022. Not fully recovered at any rate. Yes, there's a new government now, different party, but Labour hasn't exactly gotten off to a great start. Chancellor Reeves, new Chancellor, her first budget back in October didn't, I think, quite get the tone right, and definitely didn't get the expectation game ahead of time. It came across as too much borrowing, essentially, and not a clear plan for growth. Nowhere near as bad, of course, as the Trust quartering budget, but not the right tone. And you know what they say about trust. It takes 10 years to build up and 10 minutes or sometimes even 10 seconds to lose. The UK is still in the process of rebuilding that confidence among investors, and takes time, and you need to get the decisions along the way right. Now, the second reason that the UK might be more vulnerable is that the UK government has traditionally issued a lot more of its debt at longer maturities than other economies, especially if you compare it to the US. For example, more than 20% of the US federal debt is funded through short-term treasury bills, so maturity of 1 year or less. In the UK, that's less than 5% of the stock of government bonds. So much more of it is longer term, and much more of it is also inflation linked here in the UK. The share of inflation at gilt is more than 20%. That's about twice as much as in the US. Now, there are advantages to that approach. In particular, it limits rollover risks in times of stress. But at a time like this, when what investors are most worried about is the long end of the curve and the sort of longer term risks around inflation, public debt, sustainability, and so on, does seem to have left the UK a bit more exposed certainly than the US, but maybe other G7 markets as well.
I must admit, I find the scale of the sell-off in the gilt market, or at least the relative scale of the sell-off in the gilt market, a bit puzzling. Because if you look at the recent data in the UK, particularly on the inflation front, it's not been noticeably worse than any other major advanced economy, I think, on balance. I think you'd argue that some of the data coming out in the US has been more troubling on that front. Jonas mentioned the fiscal position. Clearly, the UK fiscal position is not it's not a picture of health. But by the same token, I don't think it's comparatively worse than other major advanced economies. There's nothing that's happened in the past couple of weeks or so that would suggest it's got comparatively worse. It's no worse than France, Italy, even the US. So I find when you look at the macro fundamentals, as it were, the scale of the sell-off relative to other government bond markets is a bit puzzling. I think the other explanation, other than the ones that Jonas suggested, is the fact that the UK government has tended to rely a bit more heavily on foreign creditors than compared to other governments in other countries, and that reflects the fact that it runs a large current account deficit, tends to relying on foreign investors to finance the budget deficit as well as private sector investment too. And I think one consequence of that is that the UK bond market's a bit more vulnerable to shifts in global sentiment than other bond markets. So this may be a case of simply the fact that the UK is a bit more reliant on overseas investors, meaning that it's a bit more exposed to shifts in global sentiment than other government bond markets. And when yields are rising globally, the UK just gets hit a bit harder. But certainly I think some of the headlines over the past week or so comparing the UK situation with, say, the mid 70s, I think are overdone.
I guess there's also the question of the nature of those buyers as well. There's a lot of talk when we were briefing clients midweek about the sell-off in the gilt market, about how maybe hedge funds are playing a greater role in selling this debt in this instance, how they've taken up some of the slack of buying after the LDI crisis in 2022, and perhaps they have a greater tendency to shoot first, ask questions later than the more traditional holders of this sort of paper.
Yes, I think there's something to that. I mean, as ever, whenever you get these big market moves, you end up with many different hypotheses. My sense, though, is that it's a combination of all of these factors. It's the fact that UK yields are being drugged up predominantly by what's happening in global bond markets, but then there's these series of UK-specific issues, residual concerns about the government's agenda, the fiscal position, the reliance on foreign creditors, and as you say, perhaps the reliance on some hedge funds. There's a source of demand for gilts over the past few months or so that is perhaps playing a role. But I suspect it's all of those factors in the right.
Just going back to Jonas's point about what was happening under Liz Truss, and if her lawyers are listening, that's Jonas Goltermann, MANN. We've often spoken about the need for governments to show fiscal rectitude as debt piles up and as bond investors lose patience. And as Jonas was saying, the Labour government has been at pains to show that it's a fiscal grown-up, that it's nothing like the Truss administration. And Reeves's budget, the intention at least, even if, as Jonas says, it didn't land that way, the intention was to present the budget as a demonstration of this fiscal rectitude. But it does seem like gilts have been punished unduly and that Reeves's fiscal strategy has been negatively affected by all of it. So how do we square all of this?
I think to some extent they're a victim of unfortunate circumstances insofar as had there not been a global sell-off in bond markets, then we wouldn't be talking about the government's headroom against its fiscal rules having been eradicated, which is essentially our judgment if yields stay at these levels now. It's rather than something that the government itself has done, it's been a kind of fix of moves in global bond markets. However, I think it also reflects the nature of the position that we find ourselves in, which is large government budget deficits across major advanced economies, high debt burdens. Of course, we had that wobble in France's bond market at the back end of last year. We're having a wobble in the UK government bond market this year. The UK won't be the last, I don't think, that where we see particular wobbles in bond markets over the course of 2025. I think one interesting difference with the debacle and the Liz Truss, actually I shan't call it debacle, shall I? So as you say, I'll find myself on the wrong end of lawyers' letters. With the set of circumstances under former Prime Minister Liz Truss, is that for the government that replaced her, the government under Rishi Sunak and at the time Chancellor Jeremy Hunt, it was pretty obvious what they needed to do. They just unwound some of the tax cuts. They instilled an economic council for the people made up of the markets that reassured the markets that the kind of grown-ups are back in charge. They resurrected the fiscal guardrails that had been taken down under Truss, so reassert the importance and independence of the OBR and so on and so forth. So it's pretty easy for the government in some sense to unwind those measures and get the markets back on side. It's not exactly obvious what the government now can do, because as you say, it's not really been a marked area of policy that's driven this. It's been a set of circumstances in global bond markets exacerbated by a few UK specific factors. There's not necessarily a quick fix for the UK government here, other than to kind of hammer home the importance of fiscal rectitude. And I suspect when the spending review concludes in the middle of this year, it's going to be a pretty tight one. If I was the Chancellor, I would be thinking about penciling some pretty meagre increases in public spending, and particularly at the back end of that envelope, and hoping that growth or something like that gets us through.
Jonas, let's get back to you, because for a long time now, the dollar's been the only game in town, hasn't it? I suppose you're going to say that we expect this trend to continue in light of this jobs report, but what do you see are the chances for the dollar to weaken in this environment?
Well, I think obviously the dollar is up today on the back of the payrolls, and again, it's almost Yeah, it's the continuation of the trend that we've seen since September. Dollar in broad terms is up almost 10% since it bottomed out then. About 2/3 of that is since election day. So clearly a lot of it is driven by not just the fact that the US economy is proving more resilient and that the rest of other economies in Europe and China are seeing a steady stream of bad news. It's also, as Neil was alluding to do with Trump's policies and the expectation, both on the fiscal side and on tariff policy, which both would point to a stronger dollar. Now, we don't think he's going to get all that much through on the fiscal side, but I'm not sure there's too much of an expectation on that front either, because Congress he has a very slim majority in Congress, and it does seem like some Republicans at least are a bit worried about the deficit in the US, which is very large. But we do think Trump is going to be able to bring in tariffs. Obviously, that's something he can do without Congress, and we're expecting him to go down that path. Both and that, I think, even if some expectation of tariffs is now in the price, I don't think it's if he goes with the 10% universal tariff and 60% on China, which is the main thrust of his argument during the campaign and what we expect him to put through. I don't think that's fully priced in. Especially, it's quite clearly not priced in to the dollar renminbi exchange rate, because the renminbi hasn't moved all that much at all over the past couple of months. It's down about 3% since the election. If that was moving purely based on market forces, I think it would be considerably weaker, given that if there's any one tariff that Trump is going to put through, it's probably the one on China. Bottom line is, I think there's a lot of US exceptionalism, a fair amount of Trump's policies already discounted in the dollar exchange rate, but there probably is more to come if he follows through on the tariff front.
And presume the chances of, I think you called it a Mar-a-Lago Accord the last time we spoke about it, a sort of repeat of the Plaza Accord of 1985, a multilateral effort to get the dollar weaker. What's the likelihood of that in this environment?
People have talked about this a lot, I guess perhaps in part because that was the 1980s, the heydays, and Trump is, in some sense, very much a creature of the 1980s. And obviously he has complained about the dollar being too strong. He complained during the campaign that this hurts US exporters. It's something he complained a lot about in his first term in office. And so obviously he loves a deal. Everyone knows he loves a deal. He's written many books about that. And currency deal in some sense is not that different from a real estate deal, at least in the sense you get to negotiate and put your name on it and so on, which is why some people have talked about Plaza 2.0 and other people call it Mar-a-Lago Accord. Yeah, whatever you call it. I think it's going to be difficult to pull off for two main reasons. The first is geopolitics. The Plaza Accord was an agreement between the G7 economies back in the 1980s when they were something like 2/3 of the global economy. Those are all US allies. They all get along. They all have common interests, common values, and so on. Today, for any kind of agreement of this nature to work, you would have to involve China at the very least, and probably some other G20 economies as well. And China, obviously, in the US-China rivalry is this defining feature of geopolitics today. Other G20 economies, I think, also, many of them are not necessarily allies of the US, even if they're not, maybe not rivals. See, that's going to make an agreement a lot more challenging. Even though you could see there is a common interest here in that the US doesn't want a much stronger dollar, and the rest of the world doesn't want a much stronger dollar either, because it causes problems for their economies and finances. But it does seem a bit far-fetched if you look at it politically. The second reason is just more practical nature, that the market today is very different from 40 years ago. In particular, currency markets are way bigger than they were back then in relation to GDP and importantly, in relation to official currency reserves, especially in the US and Europe. So it's going to be harder to get the firepower, if you will, to get this done. You would have to involve the Fed and other central banks in some capacity. Back in the 1980s, they were not independent from governments. Now they supposedly are, although when it comes to currency policy, it's not really, it's still the preserve of the government in some sense, so maybe they would play along. And the final point is the Plaza Accord worked out. It was a success, at least for the Americans. If you ask the Japanese about it, they might feel differently. But FX intervention more broadly is something that has been tried regularly. It's a pretty mixed track record. Sometimes it works, sometimes it doesn't. It's far from obvious that the governments will be able to bend markets to their will, even if they tried to, especially at a time where the broader trends with US policies and US economic outperformance, those all still point to a stronger dollar. Markets don't work by dictate. You can't just tell them what to do. They'll do what they want to do and what makes sense from an economic point of view.
Thank you, Jonas. Thank you, Neil. Jonas Goltermann and Neil Shearing there on another US payrolls blowout and the market implications. Our China team put out a note pre-payrolls all about why the renminbi is going to remain under depreciation pressure. I will add that to the podcast notes along with some of the highlights of our coverage of the week's sell-off in bond. In the coming week, watch out for drop-ins. These are our short-form online briefings on the Asia and US macro outlooks in Trump's second term, a briefing all about commodities markets in 2025, and a look ahead to how much more US commercial real estate could recover in the coming 12 months. But that also includes whether offices are going to see much more pain as well. Check out our events page, capitaleconomics.com/events, and we'll be back next week with more on the global macro story and what it means for markets. We didn't really get into the equities outlook just now, but next week we will be telling you why we're sticking with our end 2025 forecast for the S&P 500 of 7,000. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.